Time to go for chapter 6, and this is market geometry. So what I will try to do here is I will try in 10 minutes try to introduce you into a new field, and a totally new field in trading, the geometry of the markets. What you should take into consideration is that market moves in a specific way, and if history is an indication of what is most likely to happen in the future, then the same concept can be applied when you're trading financial instruments like you're having a currency market in here. Price is actually doing patterns that are repeating from time to time. This is why the name and the concept of pattern actually really means a pattern that once identified, you may look for it to happen on the future also. Market geometry, from my point of view, is based on taking into consideration the time element. If you're not taking into consideration the time element when you are trading, then you are missing one big chunk, let's say, of the trading. For example, if you're having a head and shoulder pattern, or like in this case, this is a chart on the Great Britain Pound US dollar 4-hour chart that I've made some time ago. It is not that old, as you can see that the price had stopped here on last Friday. It's not that old, but it's still valid today, and it illustrates exactly what I want to show you regarding the market geometry concept. If you are looking, for example, at a pattern like is the case in here, this whole pattern from the left side in here to the right side in here, it is being called an inverse head and shoulder. And you know that because we already treated the inverse head and shoulder. We had a full subchapter based on it, on the patterns when you are trading. So just look back on the trading in this trading manual. Now in this inverse head and shoulder, for example, when you are trading it, look for the pattern that it is being forming on the left shoulder, and see how price consolidates in there, what kind of a movement there is, the amplitude of the move, meaning how deep is from the moment the price entering the left shoulder to the moment it exits, the amplitude of the move, the time taken for the shoulder to be completed, and then you will try to apply these elements on the right side. So for example, if you are studying, of course you don't know in here that an inverse head and shoulder is going to happen, but after you have the head in here with a sharp sell-off and then a sharp rebound, then from the moment the potential neckline, this is being called the neckline, so from the moment the potential neckline is being hit, you are looking on the left shoulder and trying to project from this moment on into the future both the time elements, so you just take two vertical lines, for example, measure the time in here, project it on the right side, the amplitude, so the amplitude in here is something like this, and you project the amplitude in here, so you know when to you have another clue when you should step in to buy, besides this Fibonacci retracement tool that you have in here. And also market geometry means take a look at the price, taking a look at the price and what price did or does in a support and resistance area. For example, if you are looking at a support area like this area you see here, given by this pink neckline that you see, so price is coming to the upside. From the upside, it is finding a support area in here, okay, and then it is being broken. And now, normally a support area that is being broken on a move from the downside, now it is becoming resistance. And look for how many times the area has been tested before being broken, and look actually for the same to be valid on the right side. So take a look in here, price coming from the upside, finding support on the neckline, okay, and then this is a gap, so the support being broken, now becoming resistance. So it is actually making 1, 2, 3 pushes to the almost three pushes to the upside and failed, okay? And this was happening on the left shoulder. And you also have this information starting from this moment of time. So when the neckline is being tested again, so the same area of support now is becoming resistant, it is unlikely that on the first attempt it is to be broken. So if you're having an impulse like this moving here is 1, 2, 3, 4, 5, then by the time the neckline is being broken, you exit your longs, for example. So this is one time. More the next most likely, let's say, moment of breaking is the second time, but phase again, and then the third time in here. So 1, 2, 3 on the left side, 1, 2, 3 on the third time in here. It makes this kind of formation. This is being called a bullish flag. It is a continuation pattern, and on the third time it is broken the neckline. So this is market geometry. What was happening in past is going to happen in the future, or at least it would resemble. Maybe this is I don't know, too perfect of an example, but I remember this chart, and I think that this is the best way to show you what market geometry really means in my opinion. Also, for example, when you're having a diamond formation, a diamond formation looks something like this. So this is a sharp move in the middle, in the diamond, and then when you have a sharp move in the middle, then you're looking for what was happening on the left side in here. So the price is consolidating in here like this, and then you just copy these lines and project them to on the right side on the future like this. So this is a diamond. This is a diamond pattern. So basically, from this moment of time, you are just projecting on the right side what was happening on the left side, and not necessarily in terms of the candles in itself, but the time taken to consolidate on the left side. Usually, it is the time that it is taken to consolidate on the right side. In our case in here, this looks like, for example, like a small diamond in here, this one in here. So if you take a line, if you take a trend line, something like this, maybe it is more visible on a lower time frame, and you will see that what was happening on the left side in here, it is happening on the right side, giving the exact time moment to when to look for a break. Market geometry works best, especially in the case of triangles. Remember, you have contracting triangles and expanding triangles, but especially on contacting triangles, when price travels in legs of 3, you see, this is why I wanted to talk about market geometry at this moment of time in our trading journey, because we already covered contracting triangles, we already covered Elliott rays a little bit. So you know that in triangles, legs come in the form of 3, ABCs, 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 and the tendency for the subwaves or the waves of a lower degree in such a triangle formation is that both price and time is being respected almost on the same fashion. So on contracting triangle, market geometry is still very much in play. As a book recommendation for market geometry, I would go with Bryce Gilmore's book Geometry of Markets from 1999. A great book, a great reading. Let's say that my approach to market geometry is a little bit unusual, but you will find on this book way more information about a field that it is sometimes ignored by traders, because this, in the trading world that we are living in, with all these platforms out there, people tend to focus more on indicators, oscillators and technical data than on how the price actually moves. The beauty of a chart stays in studying its history and trying to anticipate future moves, and what simple works best in my opinion. And this was chapter 6. Time to move on to chapter 7, and basically we are approaching our end line for this trading journey, and we're talking in chapter 7 the fundamental analysis and what to look for when trying to see the fundamental part besides the technical.